Good morning and good afternoon, and welcome to the Center for Global Development. My name is Scott Morris. I'm a senior fellow at CGD, and it's my pleasure to welcome you to the second day of a four-day conference on the financing needs of low-income countries. We had an excellent discussion yesterday, focused on the debt risks in the current environment for these countries, and I think in some ways, it sets the tone for our discussion this morning, which is on private sector issues associated with LIC financing. And I think in some ways this promises to be a sobering conversation. Clearly, as in so many respects, we are in a challenging environment. Low-income countries are in a challenging environment. And the private sector agenda in particular faces significant headwinds given the challenges. But I will say that our approach at the center is to focus on solutions. So I think we'll hear quite a bit about what the right policy objectives ought to be, what are the approaches that can promote robust private sector investment, even in challenging times for these countries. Let me say a few words about our participants in the format today. This is an excellent group. I'm excited to hear from all of them. We're going to have a presentation first to kick it off of a discussion paper that will be followed by a panel discussion with 3 panelists. Following that, we will then have a wider group of commentators who will come in for the discussion. And in that period, we will also have the opportunity to take questions from all of you in the audience, and you will see on the screen how you can communicate your questions to us for the panelists. So let me get started. I'm going to introduce our presenter, and then following her remarks, I will introduce our 3 panelists. So I'm very pleased that my colleague Nancy Lee at the center is leading this discussion this morning. Nancy brings a wealth of experience to these issues, a distinguished career in the U.S. government, and notably at the Millennium Challenge Corporation in senior leadership position there. And in her time at the center has really focused and put forward creative, very thoughtful, substantive ideas around the private sector agenda. So she's going to give us sort of a lay of the land this morning in a presentation of the paper, and then we'll go to the panelists for their comments on the topic. So Nancy, with that, over to you.
Thanks very much, Scott. I'm really very pleased to help launch this, very important and timely discussion. Let me plunge right in and start to describe the purpose of our work in the paper that you have. And when I say our, I want to acknowledge in particular the excellent work of Mauricio Cardenas, whose data assistance was really invaluable in producing this exposition. So fundamentally, the purpose is to take stock at this point of whether the billions to trillions vision is reaching and benefiting poor countries. We're now 5 years out from the original, the advent of the vision. Now is the time to take a look at what has been happening. So we reviewed the data on private development finance flows in poor countries from 6 sources. I want to say at the outset, there are lots of data challenges, lots of gaps when you're talking about data from poor countries. These 6 sources overlap, as you can see. There is no common definition of what a poor country is, nor is there a common definition of what part of private finance actually funds development, but we erred on the side of trying to give you a comprehensive picture. We identify key findings that should shape future efforts to mobilize more finance. We make the case that major changes are needed to give multilateral and bilateral development finance institutions greater capacity in poor countries, and we offer 5 concrete proposals for strengthening and expanding the scale and effectiveness of their role. So let me go through the data briefly. Let's start with development finance institutions. And what you see here is data from the OECD Development Assistance Committee. You can see on the left that the amounts of private finance mobilized by DFIs for all developing countries are small in relation to the finance gaps, but at least you can see a very clear trend upward. If you look at on the right, however, you see that the volumes mobilized for poor countries, and this is the UN definition, are very small. 2 billion in the period 2012 to 2015, rising slightly to 2.3 in the more recent period. And the share of that volume in overall finance mobilized is also very small, 5% in the most recent years available. Now, if you take a subset of the DFI finance, particularly blended finance, you can see that the overall volume of blended finance for all countries, LICs and middle income countries, is really very small, 3.5 billion in 2018. So it's very important to realize that blended finance transactions, on which a lot of people are focused, are actually a quite small portion, something like 6% of the operations of the major DFIs. Correspondingly, the share that goes to low-income countries is 11%. So roughly 370 million in finance, blended finance commitments went to poor countries in 2018, a very small amount. You can break it down further and take a look at the shares of DFI own account commitments, that is what's on their balance sheets, versus the shares of concessional commitments. So what's on their balance sheet is 7%, a small percentage. The share of concessional commitments of overall DFI commitments is considerably larger at 19%, but it's still striking to me that something like 80% of concessional commitments in blended finance transactions goes to middle income countries. It's pretty surprising when you think of the concentration of concessional commitments on the sovereign financing side in low-income countries. Now, if you look at impact investors, and this includes both public and private impact investors, investors who invest for financial returns as well as development impact, we don't have a country income breakdown, but we do have a regional breakdown. You see on the left that many impact investors, more than 40%, have a presence in sub-Saharan Africa, a region with many poor countries, but only about 11% in 2019 of their assets under management were in sub-Saharan Africa. And you can see, if you compare rates of growth in impact investment, they're quite high for a lot of regions in the world, considerably lower for sub-Saharan Africa. And then if we look at private infrastructure finance, an area where a lot of people have been focused, you can see on the left, and this is data from the World Bank PPI, or Private Participation in Infrastructure database, that the overall volumes of infrastructure transactions with some private finance are very small in a group of IDA eligible countries. That's about 74 countries. Never reached 15 billion over the period of observation. It's quite volatile, not surprising for infrastructure transactions. No particular upward trend. And the share of overall infrastructure finance for all developing countries is quite low, somewhere around 2%, and doesn't seem to be trending upward either. On the right, you can see the Multilateral Development Bank share of PPI finance. It's interesting that in more recent years, the share seems to be lower than in previous years. So we don't see here that the multilaterals are playing a rising role over time in infrastructure finance with private participation. And then just briefly to look at cross-border private flows, on the left you see FDI, foreign direct investment, is a share of GDP for the same group of poor countries. Started out about 3.5% at the beginning of the period before the global financial crisis, and has been pretty steadily falling ever since then. Somewhere less than 2.5% of GDP in 2018. And then if you look at private portfolio of capital flows cross-border, the share is very low, less than 2%. It's quite volatile, as it is in other countries, and doesn't exhibit any positive trend. And then the last piece of data is the share of domestic private investment relative to GDP for this set of 4 countries. And it's been fairly resilient over time. It's a little bit less than 20%, but I think the important thing to take from this is that the single biggest source of private finance for development is going to come from local investors. So a focus on the financial intermediaries that facilitate that investment makes a lot of sense. So just to summarize, core findings: DFI private finance mobilized in poor countries is small in volume and as a share of total finance, and does not appear to be trending upward and markedly. There is no large-scale diversion of aid for use in blended transactions for the private sector. Total concessional finance for all major DFIs combined was a little bit more than $1 billion in 2018. So this concern that there would be a huge diversion of aid from sovereign operations to blended finance operations from the private sector appears to be unfounded. But most DFI concessional finance goes to middle-income countries. Cross-border financial flows, private flows remain small and are not trending upward. Many factors that are inherent to DFI models constrain operations in poor countries: the limited tolerance for risk, financial goals, which are really market returns, reliance on senior lending as the principal financial instrument, and focus on the volume of their own account transactions over mobilization. This is really consistent with what the DFI financial model incentivizes. So what we're essentially arguing is, without major changes in that model or operating goals or institutional approaches, it's not very realistic to expect a very dramatic increase in DFI mobilization of private finance in poor countries. So with that as the review of the data, let me turn now to several proposals. And I hope you will see the connection between these proposals and the picture that we've just presented. So first of all, the proposal number 1 is to simply set targets for shares of DFI commitments and concessional finance in poor countries. The IFC is really has already gone down this road, is blazing this trail in the context of its capital increase. It's set very ambitious targets for its presence in poor countries and fragile states. And in particular, I want to argue that there should be a much greater allocation of scarce concessional finance in poor countries. It's essential for developing bankable projects, for improving the investment climate, and for managing risks. I don't know what the right percentage of concessional finance should go to poor countries, but I think it should be way larger than 19%. The second is to really adapt the DFI model to include a financial structure capable of managing more risk. And we proposed something called the stretch fund, proposed and modeled the stretch fund, which would serve that purpose. This is an off-balance sheet financial structure that would expand the range of DFI projects that are bankable, and also take on higher risk tranches, which would result in greater mobilization of private finance through taking subordinated positions. So such a structure would target lower risk-adjusted returns, deploy more equity and guarantees, pool risk-tolerant public and private capital, promote innovation, and target these higher mobilization ratios. So it would look very different from the balance sheets of most of the existing DFIs. Third proposal is to pursue sectoral compacts to use the tools, especially of the multilateral DFIs, to both reduce and share risk. So DFIs, multilateral DFIs, have the tools in their public finance arms, to promote better recipient country policies and stronger institutions in areas with direct impact on investment viability and performance. And so I'm proposing here that they pursue a formal structure, a sectoral compact, in order to knit together the deployment of those tools. And I would suggest, and this is from my experience from the Millennium Challenge Corporation, unless you have that formal structure, which brings the people and the tools, the instruments of the different parts of the MDBs together, you're not really going to get the kind of very tightly constructed structure that incentivizes everybody in the institution to work together. This is really a little bit different from country compacts, which are also being discussed. It's more focused on bringing the private and public tools within an institution together than it is on bringing multiple institutions together. Although, of course, if multiple MDBs could participate in the compact, it would have greater scale and impact. And then the fourth proposal is to double down on building local capital markets and local intermediaries. I think that the criticism of MDBs for working through intermediaries is not well founded. I think that's the only way they'll achieve scale and market development, but they need to be much more intentional and selective in targeting the most important gaps. So we're talking about targeting early stage finance, very difficult, but the yawning gap in poor countries as well as a lot of other markets, local currency finance, equity for banks and other financial institutions that serve small clients. They need to target excluded clients like women, entrepreneurs, and finance for innovations in health, education, and agriculture, where the private sector can develop new business models and technologies that are essential to create the capacity for viable investments in low-income environment. And then finally, we wanted to propose that there's an opportunity for green finance here in poor countries. There will be, first of all, significant numbers of debt restructurings as we move out of this, out of the COVID-19 period. This is an opportunity to use those debt restructurings to foster green bonds. Investors can, if they're given the right incentives, switch out of existing assets into green bonds as part of sovereign debt restructurings. And MDBs can use their credit enhancement capabilities, guarantees, and insurance to incentivize investors to do so. And then on the private finance side, it's likely that local banks, rather than local bond markets, are a more promising near-term source of finance in poor countries. Local bond markets in poor countries are underdeveloped. So DFIs can help regulatory and supervisory authorities integrate climate change risks into their scrutiny of bank balance sheets. And they can also offer technical assistance to banks to help develop commercially viable green products and services. So we think these are the two areas, sovereign bond restructurings and local bank technical assistance, where green finance opportunities exist in poor countries. So to summarize very quickly, in short and in sum, we're not seeing the billions to trillions evolution in poor countries. DFIs now play a small role, but for very understandable reasons consistent with their models. And changes in their models and operating approaches of the sort that I've proposed are essential in the future, if the future is to look significantly different from the past. Thanks so much, Scott. Back over to you.
Great. Thank you, Nancy. And you spared me summarizing your summary. So really excellent presentation, a lot of data to consider there, and the particular focus on DFIs, which I expect we'll spend some time on in this discussion in terms of how other model operates in meeting the particular needs of low-income countries. But let me turn now to our three panelists. I will introduce them and they will each have about 7 to 10 minutes to provide their thoughts on the topic. So we have Samantha Attridge, who is a senior research fellow at ODI and is an expert on these questions of blended finance and the institutional roles of those who offer these kinds of products, namely DFIs in particular, national development banks. So Sam, will look forward to your remarks. We also have Rita Babahuga Nsanze, who is Chief Economist and Director of the Africa Finance Corporation, is a veteran of the private sector as well as the International Monetary Fund, as is her fellow panelist, Michael Atingi Igo, who is also Deputy Governor of the Bank of Uganda. So with the three of you, I think we certainly have a wealth of experience in particularly the intersection of the policy arena and the private sector and commercial activity. So Sam, let's start with you, and then we'll go to Rita and Michael.
Great. Good afternoon, everybody, and thanks, Scott. I'm really thrilled to be invited to participate on this panel today. So much of my research, as some of you listening will know, is focused in this area, as Scott said, so this issue very close to my heart. Also a great admirer of Nancy's work. And as always, Nancy's paper and presentation does, I think, a great job in setting the context for our discussion, but also, and more importantly, putting forward an action agenda, which I believe deserves serious discussion. So I'm going to start by making some quick contextual reflection, which I think is necessary. And then I'm going to focus my remarks on 4 ideas which have come out of my work in this area, much of which emulates and echoes what Nancy has outlined. So forgive me in advance. So a quick contextual remark. And I think, Scott, you mentioned this, and I guess the discussions, unfortunately, I couldn't listen to yesterday. We shouldn't make any mistake that this challenge has just got much harder and that the need has arguably got much more urgent. So we were way off track before COVID, and now there's a real risk that unless we act now and the kind of fundamental changes that Nancy's outlined, we're going to veer further off course. So I think we're at a really critical juncture. Why do I say this? I say this, and I'm highlighting the current kind of state, if you like, of capital markets, because I think we need to really appreciate the reality and kind of what the prospects for this agenda are. And I would say the prospects for DFIs in mobilizing private finance in low-income countries, doesn't look good, especially in the short term. They're going to be up, they're really going to be up against it. Firstly, we know, and you probably discussed this yesterday, that risk has significantly increased in LICs. We see a number, for example, of LICs which are at risk of seeing a downgrade in their credit rating. We can think about Mozambique and Uganda, Rwanda and Tajikistan. We also see changing in investor sentiments and appetite in several emerging markets, which is tightening, illustrated by decreases year on year on foreign currency issuance by non-investment grade sovereigns, and the fact that some governments are actually struggling to auction off their debt. So these decreases in sovereign ratings or potential decreases are very important because they will feed through and impact the credit rating of DFI investment. So investment risk will increase, it's going to be harder, and unfortunately it's going to become, the reality is it's going to become more expensive to pursue this agenda. Secondly, so not only has risk increased, as I've said, investor appetites become more bearish in emerging markets and is tightening, especially as we go down that rating spectrum. And there's a recent report which people might want to look at, the International Institute of Finance, which found that cross-border flows by foreign investors into emerging market debt and equity have not yet made up for the 89 billion which flooded out in March. And then actually debt flows were negative in August. So I think it's important just to highlight those 2 issues. And I don't want to be the merchant of doom today, but as I say, it's important because I really think it reinforces this need for a fundamental rethink on our approach and the need for some bold changes. So with that said, I'm going to outline 4 priority ideas, solutions, which have come out of my work. And as I've mentioned, echo what Nancy has said. Firstly, the need to move away from an ad hoc kind of investment approach, which is uncoordinated, to a more strategic, country coordinated approach. And at the outset, I think it's critical to reflect actually on the problem that we're trying to solve, especially in these poor countries, which has perhaps been a little bit eclipsed by the rush to kind of invest at the project level and the billions to trillions rhetoric. And at the heart of this, I see two fundamental issues. Firstly, the issue of country risk and the actual need to mitigate it at the outset rather than just transfer it to DFIs. And secondly, the lack of investable pipelines in LICs. And this is important because it informs the solutions. So the first issue, country risk and the need to mitigate it rather than just transfer it. It's stating the obvious, I think, but I think we might overlook it sometimes. And private finance is not going to flow freely to countries where the local investment climate is poor and markets are not functioning. DFI investment can only ever tip that balance. It's never going to work if the fundamentals aren't right. So I think we need to take a step back and we need to look very clearly and emphasize work on strengthening the investment climate in LICs. Here, there is a clear role for all actors, a clear role for government, and a clear role for the public sector windows of MDBs, RDBs, and donors to collaborate and support this upstream kind of policy reform agenda. DFI investment then, because that's not necessarily the role of DFIs, DFI investment should then piggyback and complement that reform agenda. And I would argue that policy reform efforts may be more palatable and easier when they are accompanied by a DFI financing action plan. So this requires a shift, a fundamental shift in the approach, I would say, to this kind of more coordinated and strategic approach. And this touches on the issue that Nancy's arguing for, and I would argue that this needs to be coordinated, and the key is it needs to be coordinated at the country level. I believe there could be a number of levels of ambition here, recognising the heterogeneity of DFIs. At the higher end, it could be organised around country compacts, or at the lower end, it could actually just involve the development of DFI country investment strategies, which lay out how the DFIs plan to achieve market creation, more on this later, and which clearly articulate how DFIs plan to collaborate with others. For example, how bilateral DFIs would partner with their sister development agencies in upstream work, building markets, a la the kind of World Bank Group approach, and the complementarity between IFC, World Bank, and MEGA investment. So again, this has fundamental implications, I think, for how these organizations are organized. Many bilateral DFIs may be organized by product, for example, and not by geography, and also how they originate investment with implications for their financing models, which I'll speak to shortly. So this leads me to the second issue and second part of this solution, and that is the lack of investable pipelines in LICs. And you hear ad hoc that there are too few projects and too many DFIs chasing too few projects. So it leaves this thorny issue, I would say, about how much of current DFI investment actually, and pardon the expression, hoovers up near investment ready ops through vanilla kind of co-financing arrangements versus DFI investment that truly seeks to create and build new markets, and this emphasis on early stage investment and building investment pipeline. So here there are two ideas here, again, echoing what Nancy's touched upon. And this is firstly a need really to focus on this pioneering kind of demonstration investment and early stage investment, where there is actually a scarcity of private sector investors who are willing to take those risks. And that requires much more use of high risk capital. Nancy's always, I always say there's a bit of a with senior debt. We need more use of grants, equity, and mezzanine financing to include convertible financing and contingent grants in this part of the capital structure. There are some exceptions to this, especially kind of on the bilateral side of things. We see CDC, IFU, Norfund, and Svedfund using a significant kind of equity or quasi-equity kind of portfolios. Secondly, And again, touching on a point Nancy's made, really, we need to be really engaging at the country level and seeking out respectable partners in these countries who can help build the pipeline and bring these deals to market and tap and develop the capital markets. And here, one area of work which I work on is on national development banks. And I think that we should be pushing these banks to partner with national development banks in these countries, with the caveat that those banks, they're respectable, kind of well-governed national development banks. Our research has found that they can play a very important role in intermediating capital, but also building pipelines, building on their unique comparative advantages. So I would argue that we need a stepped up kind of engagement with actors like national development banks in these countries. The second solution, I think, is there is a need for DFIs to significantly increase the local currency financing in these countries. In our work, time and time again, this is the key constraint which comes up, and it makes investment unviable. And if you can hedge it, the cost is prohibitive, sometimes estimated at between 5 and 10% of the project cost for some of these exotic currencies. So most DFI investments denominated in hard currency, some quick figures, 92% of the consolidated portfolio of European DFIs at the end of 2019 was denominated in hard currency. But some DFIs are making efforts in this area. IFC, for example, lends in 60 currencies, and its local currency composition was 18%. But still, I believe that this is a major gap where DFI should be doing more. So here are some ideas. DFI should explore and make more use of credit enhancement structures to enable DFI clients to borrow in local currency from other sources. This, for example, could include the creation of local syndicates of banks who could provide local currency financing with a DFI guarantee. Secondly, a much greater use of swaps. And in low-income countries, this could be with central banks where there aren't commercial swap markets available. 3, international DFIs who are debt funded and hence issue on the capital market should step up their issuance of local currency bonds. We also believe this would have the added advantage of supporting the development of capital markets, but also the diversification of their portfolios will necessarily help reduce exposure. And indeed, the diversification of currency portfolio has been one of the key factors to the success of TCX. And finally, at the bilateral DFI level, shareholders should ask their DFIs to review their models, their debt financing models, to understand their exposure if it was all denominated in local currency. It might be that with diversification, it might be less than they expect. And this could open up a conversation with the shareholder for how this risk could be funded or carried, with again implications for financing model. I've got 2 quick last points to make. The third issue is we would like to see, or we need to see, an increased use of pooled investment vehicles focused on investment in low-income countries. These vehicles can overcome the size issue, which is again another key constraint which comes up time and time again. It enables DFIs to attract institutional capital who only look at large ticket size investment and offers them attractive risk diversification, especially if these vehicles have some form of first loss mechanism, where we have seen this provided usually by donors, philanthropic investors, and on occasion DFIs. They can be quite catalytic, especially they can invest directly in funds or indirectly through sub-funds. And that latter approach is quite catalytic, as often it not only mobilizes funds into the fund of funds, but it mobilizes investment into the funds which it invests in. So finally, all of these ideas will have significant implications for the business model of DFIs. And I think it's important just quickly just to highlight and look at the return on assets of this DFIs, because I think it kind of contextualizes what needs to be done and what the challenge is. So DFIs aren't as profitable perhaps as we think. For example, the average return on assets for the group of European development finance institutions in 2019 was actually negative. It was negative 1.32%. In 2018, it was 0.6%. And in 2017, it was 2.2%. The IFC reports 0.1% in 2019, 1.4 in 2018, and 1.6 in 2017. The issue here, as you can see, is that there isn't actually a lot of room for maneuver, and there's certainly very limited headroom for these DFIs to significantly reorientate their portfolios and invest more. And this is a harsh truth. And this is where we need to be realistic about what DFIs can do, and builds on and echoes Nancy's idea around the proposal for a multilateral stretch fund. So thinking about bilateral DFIs to complement Nancy's ideas. I think that you could allow DFIs and or their shareholders to broaden their investment portfolios to cross-subsidize these higher risk portfolios. This would probably take a few years and may require relaxation, potentially in additionality policies, which may not be desirable. And we'd also need to do the sums to see if this was a realistic option. The second idea for bilateral DFIs is along the lines of what Nancy suggests, and this is to shift or set up high-risk investment portfolios off balance sheets, which donors can subsidize or underrate in other ways. Thirdly, I think that shareholders of bilateral DFIs could review other existing specialist vehicles to see if aid funding, which is increasingly being channeled through these vehicles, could be channeled through these specialist vehicles, rather than existing DFIs. So I'm thinking here about PIDGE, TCX, AgDevco, etc. And finally, some of these high-risk portfolios could be set up on the balance sheets of DFIs, but would need to be supported by a first loss guarantee, usually provided by a shareholder or philanthropic investors. And it should be noted that actually blending concessional finance, there aren't a lot of bilateral DFIs who do this. It is a multilateral, I would say, phenomenon. So in conclusion, I think we're at a crossroads, and that without fundamental change, this agenda is unlikely to deliver for the poorest countries. So focusing on bilateral DFI shareholders, they need to decide whether to channel increased resources to DFI to enable the changes to the DFI business model, perhaps even accepting break-even or possibly loss-making DFIs, or whether indeed to channel increased resource to more specialist high-risk investment vehicles. But what is clear is that channeling more aid resource in the business as usual approach should not be an option going forward. Thank you.
Great, thank you, Sam. I have to say, if the message is that the DFIs are falling short, and I think it clearly is from the data, there is no shortage of specific actions they could be taking if just looking at Sam and Nancy's proposals together. But and hopefully we'll come back to a lot of these ideas. But let's turn now to Rita, please.
Thank you, Scott. Good afternoon, everybody, and thank you very much for the opportunity to participate in this really important panel. I think first, in terms of the specific stylized facts highlighted by the paper, some definitely resonate just by looking at the AFC's book and its operations. So for those who may not be familiar, the AFC is the Africa Finance Corporation, founded in 2007 to finance and develop infrastructure, natural resource, and industrial assets across Africa. In terms of the framework set out by the paper, the AFC would probably qualify as somewhat of a hybrid institution, because we combine private sector participation with ownership with a multilateral structure. So our shareholders are the private sector, notably African banks, as well as African sovereigns and other DFIs or MDBs, for example, the AFDB. We have a small sovereign lending facility, but the bulk of our lending is to the private sector. So we have a very strong private sector character, both in terms of our model of fundraising and also the way in which we deploy that capital. So on the back of our strong rating, we have an A3 rating, which is the second highest on the continent after the FDB. We raise debt on global capital markets, and then we deploy this across the continent, across various infrastructure projects. But we also have, we have a very strong development mandate. Yeah, so in addition to sort of the profit motive, and here I would maybe counter some of the comments made by Samantha earlier, because the AFC has been profitable every year since inception. Our return on assets is around 3.5%, 4%. We think of ourselves as a vehicle, right, for foreign investors looking to take Africa risk, and also kind of a conduit for African entities with lower credit quality to access global capital markets. Yeah. So in terms of the character of our portfolio, I would say that in some ways it mirrors kind of some of the data coming out of your research, Nancy, in the sense that only one third of the portfolio is in low-income countries in Africa, and less than 10% is in what would be characterized as upper middle income countries. So this is mainly South Africa and Gabon. And then the bulk of the portfolio is in this kind of middle section of lower middle income countries according to the World Bank classification. So these are countries that maybe over the period have crossed that threshold from low income to middle income. And that's an interesting question, and a empirical question in and of itself, because we've been around for 15 years, and perhaps what's happened is this big, this group of countries that was previously low income but has experienced a big kind of growth spurt over the last decade and a half, has also been where the biggest opportunities are. Okay, so in terms of the financing structure, we're roughly 3/4 debt and 1/4 equity and equity linked, right? So kind of consistent with what you're finding. But maybe just to step back and think from our own experience and perspective, what are the key constraints that drive this picture? Why certain markets as opposed to others? Because at the end of the day, our mandate is Africa-wide. We see opportunity across the entire continent, but then obviously the portfolio has followed certain opportunities as opposed to others. And if one were to try to think why, I think two key kind of constraints emerge, right? So the first one is, your paper sort of touches on, and that's to do with internal risk allocation models and the country ceilings that are kind of sort of hard-coded into the system as a result of your internal kind of risk models, right? Meaning that a greater share of investment is naturally going to flow to wealthier countries as measured by GDP. Quite simply, the overall risk you're taking by the size, scaled by the size of the economy, is smaller in larger countries. And smaller countries also just tend to be more economically volatile. Not only that, but from a kind of a risk perspective, I would say that a larger constraint, a more significant constraint, has to do with external credit ratings, right? Because with the financing model that we have and many other MDBs have, that has a very strong bearing on how you operate and your ability to continue to raise debt. And I'll give the example of Zambia, which obviously, the sovereigns had a lot of difficulties this year, and the result of that for MDBs has been credit ratings pressure. So a number of MDBs have faced downward pressure on their rating this year purely because of Zambia. So the external credit rating is going to determine not just where you operate in terms of jurisdiction, but also the amount, the size of the investment in certain jurisdictions. A second constraint, I would say, has to do with absorption capacity. This is more likely to be an issue in smaller countries, and it manifests in different ways. For example, the government in a smaller country, you'll naturally have a smaller private sector, so the government will more than likely become your natural partner. But there are a lot of potential negative macro externalities for the government in terms of taking on the additional debt, and in terms of what that does to the country's relationship with the IMF and other donors. So okay, so that's on the constraint side. Maybe just to pause and mention that in our experience, there are two often cited constraints to why investment is not flowing into low-income countries, private sector investment, and that one has to do with the availability of capital. So one factor that gets thrown around is that there just isn't enough capital. There's a lack of capital to be deployed. And the second one, which Samantha talked about, has to do with the absence of bankable projects. So on the financing side, I would strongly challenge that. We actually see lots of developed market capital searching for impact and return. And that is only likely to increase post-COVID, given the low for longer rate environment externally. Just from our own experience this year, amidst or despite the sort of dislocation in global financial markets, we have been able to, we issued a Eurobond, I think it was in May, $700 million. We had an order book of 2.1 billion, and we managed to issue inside our yield curve. So we have continued to see significant demand, and I would argue actually the investor base is changing. Previously, it was kind of a very kind of niche Africa-specific investor, and now we've seen, just because of the duration of the low interest rate environment externally, that is starting to expand, and Africa maybe in some senses is no longer a niche destination, because investors have become a lot more seasoned. We also did issue a green bond in the Swiss market only a few weeks ago, and again that was a very competitive yields compared to what we've issued in the past. We're also seeing some interesting shifts in the landscape with some exits. The infrastructure landscape in terms of the type of investors. There've been some very high profile exits, but we're also seeing a number of new entrants into this space, driven by all sorts of motivations, not just the yield environment. On the issue of bankable projects, I'll come back to this because I really think that we view it as an extremely critical gap, and maybe an area where DFIs could do more. Because across Africa, it's not, as I mentioned earlier, it's not that there's a lack of opportunities for infrastructure financing. We think those are abundant, but what isn't that abundant are the projects that have been made bankable. That is to say, that have been sufficiently well structured to meet the stringent tests of infrastructure financiers. And I think here is where DFIs. Here's what we find, I think is problematic about the DFI model of just providing finance, because I think what Africa really needs, what low-income countries really need, is capital that will, early stage capital, which has also been mentioned, that will unlock kind of the opportunity, de-risk it, spread the risk around, so that other private investment is able to come on board. And I would hope, maybe I think for me, one proposal and maybe one action point would be to encourage DFI partners to try and allocate more of their financing towards that stage of development. So this is an area that AFC considers one of our core strengths, is that we do project development. We focus, we think of ourselves as sort of an end-to-end solutions provider. So we spend a lot of time identifying projects, de-risking, and also preparing them. We think of ourselves as sort of an incubator for projects. So project development is something that's part of our DNA, and maybe that's why we don't necessarily see the bankability as an issue, because we're able to do project development. Just moving on to the proposals of the paper. Actually, what I'd like to do in contrast, I wanted to pick up on one proposal that I found myself not agreeing with entirely, and provide a counter proposal. And that is the first proposal around setting targets for the shares of DFI commitments and concessional financing for countries. So we tend to have a slightly different view. We don't think that concessional capital is the solution necessarily in terms of catalyzing more private sector capital to low income countries. I'll tell you a bit about one kind of to get around that small country problem that I was talking about earlier. One model that we have been experimenting with, just recognizing first of all that the internal sort of risk allocation model can be problematic when you focus on nominal GDP as the measure of as the first way of determining risk, right? So maybe to clarify what I mean by that, there are a number of small countries across the continent which are small on the basis of a nominal GDP number. So for example, Sierra Leone has a nominal GDP of 4.2 billion, something like that. However, when you look at its resource base, its natural resource base, the value of that natural resource base is many, many quantums higher than its measured GDP. And I'm talking about proven reserves. Now, multinational companies know this, and they actually don't operate in the same way that DFI, or they don't view countries in the same way that DFIs do when they're thinking about their risk allocation for countries. So Rio Tinto, for instance, which has $100 billion balance sheet, derives a significant amount of its revenues from Sierra Leone, right? And the revenue that it extracts is, much higher than the GDP of this country, just as an example. So if you take Sierra Leone's iron ore deposits, it's got 12.8 billion tons of proven iron ore deposits, and it's the world's single largest source of high quality iron ore. At today's market rate for iron ore, that's equivalent to something like 10 trillion dollars. So this is many quantums of its GDP. But if we're very focused on GDP, we lose sight of the real value in the country. Guinea is another example. GDP 13.5 billion. This is a country that holds the world's largest confirmed reserves of bauxite. And of course, bauxite is the raw material that goes into the production of aluminum. At today's current market value, that's equivalent to over $300 billion. So what we've come up with on a sort of on an experimental basis, we're trialing this out with one particular country is to say, look, okay, let's not focus so much on the GDP. If our goal is to help this country unlock its mining resource and its potential, what we've come up with is what we call a natural resource prepayment facility, where we give the country a certain amount of lending, right, which is probably going to exceed what the GDP allocation would imply, but we kind of size the lending according to the potential stream of revenue from its natural resource if that was commercialized. And the upfront sort of large size of the lending is also supposed to kind of recognize the immediate need, right? Because countries are grappling with the financing issues because of the COVID pandemic, but at the same time, we want to balance that against our mandate, right? So it's not just cash to spend, but we want to make sure that this catalyzes real investment in the economy. So the prepayment facility is something that countries can use, but a portion of it, 10% of the facility, will be used to seed a sovereign fund, a sovereign authority of some kind, which will be responsible for managing with our sort of expertise and intervention of our experts for kind of managing the mining resource. So the mining concessions, which will be given to the right private sector operators who can then commercialize them and provide two streams of revenues: income, dividends, and royalties that then go back into this fund and provide, on one hand, an immediate kind of cash pot for the government to spend on social infrastructure, right, on health, education, agriculture, and then also kind of a longer term stream of income from helping to commercialize the mining sector. Now, from our kind of initial trial with this model, we think that, so for example, $100 million investment in this particular country has the potential to catalyze an additional 2 billion, to crowd in 2 billion from just purely from the private sector in terms of their participation in that mining sector project. And it's a model that's, that doesn't rely necessarily on concessional financing, but is also, it's not, because it's sort of off balance sheet, but in a way that is, that doesn't create contingent liabilities, because the off balance sheet vehicle is has a positive net worth. We think is sort of a kind of a win-win solution. So with those comments, I think I will leave it at that.
That's excellent. Thank you, Rita. And particularly helpful to have the actual experience of the Africa Finance Corporation and positioning that in reaction to what you saw in the proposals put forward. So let's go now to Michael, last but not least, to give panelist remarks.
Thank you so much, and a very good afternoon, morning, evening, wherever you are. First of all, I would like to thank the CGD for inviting me to be a panelist in this very interesting discussion, and also to thank Nancy and Mauricio for this insightful paper that they shared with us. Last but not least, to thank Samantha and Rita for the very useful comments they have provided on the paper. And as is always the case, when you speak last, most of your ideas you want to share have already been mentioned, but I'll just endeavor to see what I can re-emphasize. So I think the paper by Nancy and Mauricio does a very good job in identifying the constraints to DFI flows to low-income countries, and also to note that these flows are kind of like concentrated rather in the middle-income countries. And what's quite interesting are the 5 proposals that they put up to spur private financing in the low-income countries. Now, the paper does a good job in trying to analyze the kind of financing framework that should be adopted to stimulate more private financing into the leagues. And I would like to echo the point made by Samantha and also emphasized by Rita, that probably more could have been said about the macroeconomic framework of these countries and the doing business kind of indicators in these low-income countries. Because the data that they come up with there is that since the move from billions to trillions, we have not seen much of the resources flow into low-income countries. So the question is why? Is it just the absence of a financing framework, or there are other issues that are actually constraining the flow of these resources to low-income countries? And that's why I would like maybe to look at it holistically and then try to comment on the 5 proposals that have been put forward. But importantly, the paper raises some lessons and the questions that we're trying to answer. And they pose a question, or they pose an observation that the global infrastructure for participation by the private sector financial transaction, I think needs to be enhanced so that we can divert some of these resources to low-income countries. And of course, they also try to explain what is showing or relating to FDI trending downwards. That's what I am going to focus on. And then my other question then is, how can we leverage on the DFI resources in order to use them to catalyze private sector inflows into low-income countries? Now, on the 5 proposals that they make, I would like to agree with Richard that setting up the targets may not necessarily be an optimal solution, because we've in the past set these targets. For example, I mean, whenever you attend an international aid conference, they re-emphasize the point that advanced countries should commit 0.7% of their ODA to, I mean, also the 0.07% of their GNI as the ODA contribution towards the low-income countries, and that was in 2005. But the target was for 2015. But by 2015, we had not yet even gotten anywhere near. All right. So I'm not sure that setting those targets will actually be the solution going forward. And then also, if you look at the business models of most of the MDBs, the likes of the World Bank, African Development Bank, Asian Development Bank, you know, they are kind of like guided by the sustainability frameworks of these countries. And of course, they need to get an assessment letter from the IMF in order to give them some kind of reassurance that the macros are in place. And if you look at the DSS of some of these countries, they cannot really accommodate any more additional financing, notwithstanding the infrastructure gaps, because there are issues to deal with the thresholds of the metrics that are used in the assessment of the risk of debt distress. So just setting a number there without doing something on the side of the desensibility and its metrics may actually not produce the desired results. And then it goes also back into what I said before, that if you have a poor investment climate, if your macros are not that good, if you don't have a strong institutional framework, the challenge then comes is whether you put in place some targeted values for disbursement to the low-income countries without addressing these issues, the absorption of these resources may not be possible. So, but I like the second proposal about the DFI model to change to focus on managing risk, sharing risks, and creating bankable projects in poor countries, and particularly through the sectoral compacts that support policy and the institutional reforms through the kind of financing that we get from the DFIs. I think to me, that is the way to go, because if you look at one of the key reasons why private sector financing is not flowing into these countries, they are perceived to be highly risky from several aspects. So I think trying to use the project financing to address or to mitigate some of those risks could maybe go a long way in trying to improve the conditions that could attract private sector flows into these countries. And even the use of the stretch funds that has been highlighted by Nancy and Mauricio, I think it's a good idea, but it has to be accompanied by other reforms. And I agree on the issue of local currency bond markets. I think I will come back to that later on and then try to understand what else can be done to strengthen the local currency bond markets. Now, I know the issue of social compacts was mentioned, but I think country compacts seem to be playing a much more, I mean, if you look at the impact of the country compacts, from my perspective, they seem to be delivering. And why am I thinking like that? I want to look at the compact between the G20 and the African countries, what they call the Compact with Africa, the G20 Compact with Africa. What is interesting about this compact is that the G20 has committed to marketing the participating countries, the compact countries, in their countries in order to see how they can leverage on the private financing that is available in their countries. So they're acting like marketing agents, and they're also trying to see how to address the issues of the high risk of the businesses in African countries. But what is important is that the African countries have got also a part to play in that they need to articulate in their national development plans what they are doing in order to make private sector financing much more attractive. So to highlight the kind of business reforms they're undertaking, the kind of environment they are putting in place in order to make the returns of investing in their countries much more comfortable and attractive, and a host of other reforms that they are likely to, to undertake to support the private sector investment. And then this partnership also has the participation of the international organizations like the IMF to ensure that the macroeconomic environment is actually sustainable going forward. And you have the multilateral development banks like the World Bank and then the African Development, of course, trying to help in terms of strengthening the business climates in these countries, and then also financing some of the critical infrastructure that would actually make investment in these countries attractive. So if I look at the performance, because this compact with Africa came into force sometime in about 2018, seriously, and to date we have about 12 of these countries. And if you look at how they have improved on their doing business reforms, close to about 50 business reforms have been implemented by these countries over the last 2 years. And you look at an average of about four reforms per country, compared to an Africa average of about 1.7 reforms per country. So in terms of improving business reforms, I think this compact has delivered in that area. Now, of course, what we're waiting to see, is that going to lead into increased private sector flows into these countries? I mean, time is going to tell. But if you look at even within these compact countries, 3 of them, like Cote d'Ivoire, Rwanda, and Togo, were among the top 10 countries that performed very well in doing business reforms in the last few years. So I think that kind of compact that addresses the key constraints to doing business, that has been supported by the G20, by the national development plans, and also by the international organizations, has kind of like delivered. Now, what are some of the things that we need to be mindful of? I think what we see from this is that sometimes the commitment to reforms has not always translated into increased and sustained private flows for all the countries that have implemented these reforms. And again, there are a number of some country-specific factors that are responsible for that. And institutional reforms, mobilization of domestic resources, debt management, these are some of the key reforms that need to be undertaken. Because if I'm a private sector player and I want to put my resources into one of these league countries, I will need to see what is the future like? What is the medium-term outlook like? What does the macro framework have in place in order to guarantee the returns? What is the political stability like? So all the things are important and complementary factors that have to be addressed. But importantly is the aspect of mobilizing domestic resources. When I come to talking about the SDGs, maybe I will say more about that. So now let's look at the performance of some of these countries that are participating in the compact with Africa. True that these countries were already maybe star performance, but what we've seen is that over the recent past, they continue to outperform the rest of the African countries in terms of GDP growth, in terms of attracting DFI flows to these countries. They continue to attract more compared to others. And also, like I've mentioned before, the ease of doing business, they have scored very well in that area. So I therefore then come to the last part of my presentation. What should then be done going forward to spur DFI flows to the leaks? So I think what we need to understand here is that I think we need a comprehensive approach in inspiring these flows into these countries, addressing all these issues, sectoral issues, economic, political, and institutional issues. So, but importantly, risk mitigation and sharing. How can the DFIs participate in that area? And then also, maybe it is a high time the DFI models began looking at organic evolution of indigenous Pan-African businesses, entrepreneurs, innovations that have shown tendency to overcome the risks in a continent like Africa. If you look at a number of the service providers in Africa, things like the Pan-African banks arising out of South Africa, cutting across the whole of Africa, some Nigerian banks, Kenyan banks that are going across the region. Notwithstanding the risks in the continent, these banks have spread their wings across the entire African continent. Look at the hospitality industry, the chain of hotels that are rising across the continent. Look at the telecom companies, the likes of Airtel, MTN, that are going across the whole continent. Then the chain of supermarkets, all right, that have gone across the continent. And then some innovations like the mobile money that have actually, revolutionized the way digital financing is taking place in Africa. The question then is, these are all continent grown investments. So what are the key lessons that we are learning from these businesses, entrepreneurs, and innovations that the DFIs could consider financing? And so if we are talking about changing in the business models, I think it is a high time we began having a discussion with some of these homegrown, continent-grown businesses to better understand what do they do and what can be done to further mitigate the risks. And maybe the DFIs could put in more money there, because a homegrown business that understands better the risks, the challenges, the culture, both political, social, and economic, I think has a much better tendency to succeed in this environment. And then you also need to look at what has been the most recent development, the African Continental Free Trade Area. I think the question that we need to ask ourselves is, how can we re-engineer and repurpose this arrangement to support the creation of regional value chains, supply chains, so that they take advantage of the expanded market within the continent. And that should allow in more flow of capital and investment into the region. Because what COVID-19 has showed us is that following the global disruption of the supply chains, a number of African countries were affected because they could not meet the critical inputs that they wanted to sustain their health and other industries that they have. So how can we use the Continental Free Trade Area to promote regional value chains and ensure that more capital and investment flows? So maybe these are some of the areas that the DFIs should consider putting some financing, because no amount of financing that DFIs can give the governments will be sufficient to unlock the infrastructure financing gaps. I think the role of the private sector here is very, very important in closing this gap. So maybe the DFI financing should actually go to risk mitigation, promotion of public infrastructure. That should crowd in more private sector financing. And then let's look at the long-term financing. I know Nancy and Mauricio had actually talked about the local capital markets. What's quite interesting about these markets is, if you look at the stock exchanges in Africa, they're so fragmented. A little country, a small country like Rwanda, like Uganda, like Tanzania, they each have a stock exchange. But then if you look at the number of shares traded in that stock exchange, it is quite dismal. So maybe we should look at how can we amalgamate, right, some of the stock markets, make them one stock market, maybe regional stock markets, right? Maybe using the Nairobi Stock Exchange to have all these companies in the region listed in the Nairobi Stock Exchange, all right? In that way, you are broadening, you are increasing the coverage so that firms that need to list on the stock exchange, all right, not only are they coming with higher standards, but also the capacity to tap into a wider pool of investors becomes very important. So how can the DFIs support that kind of thing? A number of countries have struggled in terms of extending the yield curve in order to provide benchmark pricing for the private sector. But the private sector has not been able to take advantage of the extended yield curve to generate financing for their undertaking. So the question is, what is constraining the private sector from taking advantage of the extended yield curve to use as the benching, as a pricing benchmark for their own capacity to mobilize long-term financing? So these are the things that we need to to consider. And then fundamentally, the issue of micro, small, medium enterprises. Again, these are bankable projects because if you look at their capacity to employ the bulging youth population in Africa, they are the drivers of growth going forward. They are the drivers of employment going forward. The services industry that I talked about that is Pan-African is not job rich, but the job rich enterprises are this micro, small, medium enterprises. So the question is, how can we provide more long-term financing in order to create a productive capacity for micro, small, medium enterprises? I have a good example in the case of Uganda. Following the COVID-19 pandemic, because a number of small micro enterprises were not able to access borrowing from the formal financial sector, they were not able to benefit from the credit relief measures that Bank of Uganda had put in place to to benefit the borrowers. So what the government did, they accessed the rapid credit facility from the IMF to deal with this credit, to deal with this pandemic. And most of that credit was actually channeled to the development bank to see how they could help the micro, small, medium enterprises recover from this COVID-19. And the impact is beginning to bear some good fruit because these guys have actually seen some relief coming to them. And I think they are thinking of scaling up this model. So how can we mobilize more financing in there? And then finally, the issue of technical assistance. I think it becomes very, very important to build the capacity of the institutions in Africa regarding project financing, project selection, and what have you, because this is one of the issues that is lacking. And then on a final note on the SDGs, I think the SDGs is really becoming a challenge in terms of identifying the financing. So the only way that we can see sustainable financing for the SDGs is through mobilizing domestic resources. So the challenge then is, how do we mobilize more tax revenues? We can mobilize more tax revenues if we have an active private sector. That's when we can get revenues to finance health, education, and other social sector expenditures. But the question then is, how do we grow the private sector? We can only grow the private sector by increasing private sector activities, which if funded by flows, external flows, domestically mobilized resources, will then lead towards financing these SDGs. So short of that, I don't see loans, I don't see grants coming to help us achieve the SDGs. I think this is gonna be a domestic effort, and I think we need to see how we can support those domestic efforts, particularly the private sector, to contribute through taxation and financial sector intermediation. And then finally on COVID-19, I think COVID-19, because of the uncertainty in its intensity and duration, is posing significant challenges, particularly on the solvency and the liquidity of the number of countries in the African region. If you look at the debt sustainability indicators, they have all been impacted. GDP, stock of, exports, you name it, and then look at the liquidity, indicators, tax revenues, export revenues have all been impacted. So we are seeing a deterioration in the risk of the distress indicators, which cannot now enable these countries even borrow more to address these issues. So we need to see how much more of the private sector flows that we can mobilize. Yet at the same time, the space for financing the huge expenditures needed to address the COVID-19 pandemic related issues is growing by the day. So it is really challenging for us. And I think we need to really put our heads together to see how to get more private sector financing. So on that note, I would just like to end by saying that the DFIs need to think about how they're going to structure their financing to meet the unique challenges that the private sector in Africa faces in terms of risk mitigation, risk sharing, and consider the impact of social and country impacts as well. Compacts. How can we bring this together to address the key constraints? On that note, I'd like to thank you for listening to me. Thank you very much.
Great, thank you very much, Michael. This has been, and thank you to all the panelists and Nancy as presenter, really an excellent discussion. One measure of which is that we are way over time. So I want to go directly to the next portion of our discussion. But first, just a reminder to the broader audience that you can submit questions to the group through Twitter at CGDev, hashtag CGD Talks. You can also do it directly on YouTube as you watch this. But for now, what I want to do is go to our wider group of discussants. You know who you are. And just a reminder, you should raise your hand on the Zoom function to let me know that you'd like to come in, at which point I would ask you to unmute yourself and turn your camera on. And just a plea that it would be helpful to have very brief remarks. That we have quite a number of discussants, so you know, just a couple of minutes would be great. I should also say, I want to give our panelists an opportunity to come back in to react to each other and what they hear from this broader group. But let's jump right in. And I see Neil Gregory, you have your hand up. So Neil, go ahead and turn your video on and offer your comment.
Okay, I think I need somebody to turn the video on for me. I have my sound on, hopefully you can hear me.
We do hear you, so go ahead.
Good, so thanks, very good panel discussion on a very important topic. I just want to make a couple of related points. The first thing is when we talk about the lack of deal flow and projects to invest in, I always pause at that description of the problem, because DFIs don't invest in projects, they invest in firms. And you can do all the project development you like, but in the end, if you don't have a sponsor to actually be the lead investor and to manage the project, you don't have an investment. And so I would argue that the biggest gap in Africa and other low-income countries is not the lack of projects, it's the lack of large firms with the capacity to actually be the sponsors of projects. We just published research which shows that there's not a missing middle in low-income countries, there's a missing top. There's not enough large firms of the capacity to make the kinds of high productivity investments which we need. And so that's the first challenge for DFIs, is there aren't enough good sponsors, good firms for them to invest in. How can DFIs help contribute to filling that gap? Critical to growing more firms is private equity and venture capital. Debt is only useful if the firm first has a good enough equity base. So the ability of DFIs to provide more equity is going to be critical. To do that well, you need to have more field presence. And that's a constraint for DFIs. You can make loans sitting in Washington or London or elsewhere, but to be a successful equity investor, you really have to have the presence on the ground. And that's something that DFIs in many cases don't have enough of. And then the last point I want to make related to this is that I think we should also look at this question of risk appetite of DFIs and relate it to the cost of capital. That the global cost of risk-free capital has been low since the global financial crisis. The COVID crisis means we expect it to stay low for a long time, virtually zero on a risk-free basis. And I don't think that the hurdle rates that DFIs are using in many cases reflect the actual cost of capital. And the reason why they have to keep their hurdle rates high is to cover their fixed costs, particularly for expanding their field presence, which I just said is very necessary. So something to think about is rather than trying to use blended finance to raise the returns to DFIs so that it exceeds their hurdle rate, maybe we should use concessional money to actually cover the fixed costs of expanding field offices, which will then enable DFIs to operate with a lower hurdle rate and find more investments that therefore give a risk-adjusted return that is financially sustainable for them. So just a few different ideas to suggest.
Thank you, Neil. And I should have, I want to ask people coming in to introduce themselves. Neil's with IFC, but for others coming in, please do introduce yourself. And next, Catherine Tan. Go ahead, Catherine.
Hi, my name is Catherine Chan, and I'm a program officer with the Bill and Melinda Gates Foundation. So first of all, I wanted to thank our presenters today for raising some very thoughtful issues. So I wanted to make a couple of points that stood out to me, and I think it's really just synthesizing some of the points that the different presenters made. I think the first point that stood out to me is that it seems that on the DFI side, and especially the multilateral DFIs, maybe the bilateral DFIs to a lesser extent, I think there are pressures coming from multiple sides, and there's a pressure for DFIs to sort of be all things to all people, which I think ultimately, as our panelists have pointed out, is unsustainable. And I think there are also some tensions that I wanted to highlight in some of the recommendations that Nancy and others have made, which I think implies the need for those of us who care about these things to make trade-offs. And I think one of those tensions is the idea of volume versus risk-taking and early stage finance. I think it sort of stands to reason that if we want to pursue early stage deals, and if we want DFI and concessional capital to be more catalytic, those deals tend to be smaller, and that's just the reality, and they tend to take longer to develop. And so there is sort of an inherent volume trade-off, where on the one hand, if you're trying to optimize towards a target versus on the other hand, you're trying to find sort of catalytic deals that really fill early stage needs, there's sort of an inherent tension that I think needs to be resolved. And I don't think that's necessarily unresolvable, because I think there's a way to look at sort of volume as a goal over time. And I also think the idea that both Sam and Nancy raised of segregating, looking at sort of the riskiest investments and seeing whether, those investments could either be pooled in off-balance sheet vehicles, or in the case of bilateral DFIs that don't have to go to the markets to raise their capital. So I'm thinking the CDCs of the world. I think some of those agencies have basically designated specific parts of their portfolio where the hurdle rates are even more relaxed, or where they're able to deploy sort of even more junior instruments. And I think that could be a valuable way to think about it, because I think there are some of these inherent trade-offs. And then the other point that I think I'd want to reinforce that the panelists have made is really this need for upstream engagement. And I think, to the point made by the different panelists, there's a lot to be done on the upstream front. And to Neil's point, it's not as simple as just project development, right? There is policy reform, there is investment climate reform, there's, building up the firms, and obviously DFIs can't be expected to do all of those things. So I think the idea of better coordinating the upstream, and I know IFC, has made efforts to do that with their upstream strategy, but better coordinating the different actors that need to be involved for the upstream development, I think is that suggestion resonates with me. And then I think the final piece, right, is from the Gates Foundation's perspective, I think we're interested not just in just private sector development broadly, but the idea of how can private finance, and particularly when concessional capital is involved, be used to spur more inclusive growth. And I don't think that's necessarily a straightforward question, but I do think some of the suggestions that Nancy has raised in terms of not shying away from opportunities to invest in health and education and agriculture, even if initially the volumes may be low. I think that is an important point. And then I also think strengthening local markets and addressing those key bottlenecks at the local level is essential for sort of sustainable and inclusive development over time. Thank you.
Thank you, Catherine. Manfred Scheppers, please unmute yourself and introduce yourself.
Yeah, thank you, Scott, and thank you for enabling us to participate in these challenging times. Yeah, my name is Manfred Scheppers. I, for 10 years, was the Vice President CFO at the EBRD, and I'm now back in Amsterdam and with Cardano Development, which manages TCX and Frontclear. We're now establishing ILX as an institutional platform for co-investment with development banks. Although confidence levels, I think also some of the debates appear low, I just want to give a sense of optimism in that the role of the DFIs in terms of their channel of capital towards the emerging markets, I think, is only going to be re-emphasized past this crisis we're currently in. In terms of their local presence, their knowledge of local stakeholders in relation to policy that was mentioned, but also, which for the institutional market is so critical these days, is the whole ESG safeguarding, which the local presence facilitates. And I think was also mentioned the ability to provide local currency finance and equity. So I think the role of the DFIs over the coming decade is going to be unquestionable and will not be able to be, I think, really significantly replaced by either commercial banking or capital markets, even in relation to sustainable investment. The second point I want to make is just on the whole issue about returns, which was raised in terms of returns on assets of the DFIs themselves. The whole concept of return and risk for the institutional market these days is very much up in the air. It remains to be seen what the returns will be in alternative private equity or private debt, or even the capital markets over the coming years. So what I'm noticing is that the question about return is very much related towards the risk that headline return has, and also is very much related to the impact it has. There are many, and these are literally trillions of euros in Europe alone that are trying to determine what level of return and risk versus sustainability impact people are looking at. So I think there's a big debate there that we should not shy away from. Of course, it's hugely dependent on data. The risk data from DFIs that is coordinated via GEMS, I think is something that particularly people want to know what is the impact of this crisis on DFI portfolios. This is something which is critical to be efficiently channeled so that the institutional capital can understand it. The progress that is being made in relation to ESG and the SDG targeting and the process of the HIPSO indicators out of the DFI community. These are initiatives that need to continue with full force because without the data transparency, both on the risk return and on the ESG and impact side, I think that will remain difficult. Pipeline data, of course, it's a mystery. There's a lot of confidence, and it's clear that the additionality of the DFIs will be immense over the coming decade. But we need to get more transparency over the pipeline of projects that the institutional market can look at. And lastly, in relation to blending, what I notice is that it's not necessarily about blending for reduction of risk. I also see increasingly a desire for blending to overcome the inefficiency of the marketplace. It's going to be a long time before we see securitization technology being used within the DFI space, just because of the lack of data, the lack of granularity of data. Whilst at the same time, sovereign risk is priced incredibly expensively, both in North America and in Europe. So the use of those guarantees at the level of low risk can also be a very interesting tool to kind of leverage the returns that investors are seeking in the more riskier tranches. So it's not only for risk reduction also. So those are the kind of 4 or 5 points I want to raise to give a sense of hope that the mobilizing of private capital is still something that is very much alive.
Great, thank you, Manfred. Let's go to Susanna Gable. Susanna, please turn your video on, unmute yourself, and introduce yourself.
Thank you so much. I'm Susanna Gable, Chief Economist at SIDA, the Swedish Development Agency. And thank you so much for a very interesting discussion. Each comment I had has just been ticked off. It's been very rich, so thank you for that. Maybe on one point, it would be interesting to hear a bit more, and that's on the effects of COVID. You may argue that post-COVID, our goals in terms of development is still there at the country level, but also at international development, and that they haven't changed at least as much as on the financing side. There we know there's been massive changes and the landscape is totally different. And these days, with these seminars we have together now, will show that clearly, or are showing that clearly. So in this discussion, what does that say about what we have come back to several times during this event, where the really binding constraints are? Have they shifted given what has happened now during COVID? And I would say it's not only are the binding constraint in the more general business environment, but obviously there's a big answer there. But also, is there other flows that are more constrained at this point? We talked yesterday about the debt situation. We have the fiscal space that is completely exhausted in many countries. Even at the micro level, when you look at the firms that have made it through the crisis, they have completely depleted their savings. So what do they do now when they want to expand? So if we can come back to that discussion, that would be very interesting to hear your comments about that. Thank you.
Thank you, Susanna. And I do actually want to take the opportunity to come back to the panel, particularly with that direct question, which I think is important, is dealing squarely with the crisis itself and the implications for this agenda. Let me, though, try to pick up a question. So Catherine Stodolka, you had posed a question in the Zoom chat. You're welcome to come in and ask it yourself right now, or I can read it. Catherine, do you want to come in?
Hi there, that's really kind of you. Happy for you to read it because I'm in a bit of a noisy space, but yeah, mainly I'm excited to understand whether the opportunities for some of these innovative financing mechanisms can also apply to natural capital. We're obviously talking a lot about debt for nature swaps, but with the particular structure that was mentioned around natural resources, particularly mineral resources, whether there's an opportunity to extend that. But thanks so much. It's been a really fantastic session.
Great, thank you, Catherine. And so that question posed directly to Rita. Let me, let's pause with comments from this broader group and go back to our panelists. There's been so much put on the table. Nancy, it's been a while since you've come in, but let me throw it open to all of you to provide some reactions to what you've heard so far. So it doesn't need to be a summing up at this stage, but just feel free to come in, and particularly if you had any direct questions posed to you that you'd like to answer. Nancy, did you want to come in now?
Just to agree that this has been a really interesting discussion with a lot of ideas and some new ideas that I think are very helpful. And I find the comments on the proposals that both I and Sam made very useful as well. And let me just list the things that really struck me. Number one, Rita's focus on early stage capital and the incubator role, and this innovative idea of judging an economy in the sense of its resource endowment. And as Catherine said, you could include its renewable resource endowment as part of that assessment of an economy's potential, and in turn, its debt-bearing capacity. I think that's really interesting. I think Michael's proposal about having the DFIs focus on developing regional value chain is really interesting. It's not just a question of regional infrastructure, but that's part of it. It's also how should DFIs think about investments in different countries in ways that create a cross-border larger market for the benefit of multiple countries, and this notion of a sort of rational way to develop capital markets so that they're less fragmented, and every poor country doesn't need its own stock exchange, also very interesting. I thought Neil's point about the fixed costs of field office expansion is really interesting, and should that be a principal focus of the concessional part of blended finance. And I really liked Catherine's reference to health, education, and agriculture. As I had also mentioned, innovation in those fields and the importance of allocating private finance to those sectors where the private sector has to play a critical role. I think it's important to emphasize that only governments should not be associated with health and education, that there should be a private sector role in poor countries. And I thought that, Manfred's point about blending to overcome the efficiencies of the marketplace, such as securitization, is also something really that would be important to pursue. Thanks.
Other panelists, Sam, Rita, Michael, would you like to come back in?
Yeah, I think it's an interesting point about, considering the natural resource space as well as the kind of a country's mineral resource. It's not something that we've explored.
Okay, Rita, so I think Yeah, there you
Sorry,
are.
I was speaking. Sorry.
And
Um, I was
if you could turn your video back on, that'd be great.
sorry, my internet's incredibly unstable. If I turn it
Sure,
on,
sure.
we're going to lose me
problem.
altogether. No, just I was just going to the point I was reiterating just very quickly is just in terms of a country's natural resource space. I mean, of course, one would have to get a bit more creative about how you commercialize that revenue stream, but in principle, I mean, I don't see why that couldn't be part of the model. It's not something we've explored.
Okay, thank you. Sam, I think you were coming back in as well. You unmute. You're still muted.
Sorry, my
There you go.
apologies. So yeah, interested in the hurdle rates and interested in Rita's hurdle rates. I mean, those hurdle rates were for the European DFIs and what IFC has reported, and obviously AFC is a hybrid organization. And I think it's quite interesting. I think there is this just very real issue about either kind of the ring fencing of high risk portfolios and what that means to the overall kind of return of the DFI, and whether shareholders should be reducing that expectation. So for example, in the case of the UK, I think in 2017, these kind of high impact funds were moved on the balance sheet or CDC, but they reduced the target rate of return from 3.5 to break even. However, the return rate is very low. You can see kind of on average. Of course, there is variability, and it depends on the kind of instrument use as well. So Neil was saying about more use of equity. Equity kind of returns are highly volatile as well, which can influence that overall rate of return. So the instrument mix is also going to affect that. But I think, as I say, I think we need to be just realistic about those kind of hurdle rates, and whether or not kind of the rates which currently are being reported on average, if you average them out to take account of kind of any cyclical effects, when you look at then introducing high risk portfolios or instruments which have higher risk and probably more variability in their return, and imply a change in their operational model, a la Neil's comment around increased country presence, there is an issue actually about whether or not these DFIs potentially may even become kind of loss making, and how politically palatable that is, which then leads you down the avenue of actually the special purpose vehicles and off balance sheet financing. And then just a quick question, reflection on the health issue. We recently did a study and published a review of DFI investment in health in, I think it was May. And one of the key findings that we found there was DFIs do invest in this space, not a lot, but what's interesting is actually the kind of the catalytic capital, that high risk capital, actually is often at that bottom end of the structure, is often provided by donors themselves through first loss guarantees or through philanthropic investors. And then you have the DFIs coming in, and then you might have kind of impact investors coming in, and then you over time probably have commercial investors coming in. So again, this points to this issue related to my previous comment about business models, and that is, how viable is it for DFIs to provide that kind of capital at the moment without changes in kind of business models or expectations about the return that they earn.
Great, thank you. And Michael, you wanted to come back in as well.
Yes, thank you so much. Just very briefly, I like Neil's point about the missing large firms. However, I think we have to be a little bit careful here, because it depends on what type of economy you are talking about. If you look at some of the economies that we're discussing, these poor countries, low-income countries, I think it is the limited middle class, the absence of a strong middle class, that is to a large extent constraining growth. So If you then have to ask yourself, do you need large firms to do that? I think the answer depends whether these firms are job rich, creating, or they are highly capital intensive. Most of the services industry, for example, that I would call the large firms. If you look at the proportion of labor that they employ compared to the stock, I think it's quite small. So I think looking at the small, medium enterprises, which have the capacity to employ more people, particularly in a continent that is faced with challenges of huge youth bulge without jobs. I think the effort that are addressed towards creating jobs through financing small, medium enterprises become very, very important. And I think really most of the private sector financing should actually be going there, because also we are constrained by significant flows of this financing. So we need to see how much we can mobilize from our existing resource base. And then with time, some of these small, medium enterprises can amalgamate into large firms. So it is a matter of sequencing dictated by the stage of development that one is in. But I agree with you that large firms are important, but depends on the stage of economic development that one is in. So otherwise, I agree with most of the comments that have been raised, upstream engagement, etc. Thank you so much.
Thank you, Michael. I have to say, I think all of you have done such a good and thorough job. As I look at the questions that have come in, you have answered them. So let me suggest this in the way of wrapping up, and this is directly to our three panelists and Nancy Lee, our presenter. So again, so many issues put on the table here and a lot of insight. Let me try to simplify our wrapping up in this way. So all of you, I think, in your careers have been around things like the G20 process and understand the role the G20 plays, particularly in crisis periods like now. So I'm curious, as I think about this agenda broadly, how would you boil this down? What's the most useful thing if we're thinking about the next G20 leaders statement, which can either be a statement of action or frankly rhetoric, but rhetoric plays a role too. What's the most important thing the G20 as a body could be saying right now, speaking to this set of issues? And considering G20 countries' roles as owners of DFIs themselves, as developing country markets themselves in some cases. But what's the agenda here that they could usefully take up, particularly as we navigate this uncertain period and try to get back to some normalcy where you again are confronted with all of the challenges so many of you have pointed out when it comes to the private sector agenda. But what are the marching orders for the international community right now? So that's my charge to you in the way of trying to sum this up. And why don't we just go? Let's go in our order of presentation and well, no, let's do it the opposite. I want to give Nancy actually last words since she had to do the work of the paper and presentation. So Michael, let me ask you to come right back in and if you have any thoughts on that question.
Thank you very much. If I were to propose a message to the G20, I would really say that without creating any new initiatives, how can we strengthen and expand the compact countries that they have with Africa in order to mitigate risk, catalyze more private sector financing, and support the business reforms that are being championed in some of these countries. Just as simple as that. Thank you.
Perfect. Rita, do you have any thoughts on this question?
I do. Thank you. So I think that in terms of where to look for the next source of capital, that rather than focusing on local sources of capital, which are maybe a little bit more difficult to unlock in the short run. That if the focus were on incentivizing capital that is external to the continent, I think developed market governments have a role to play there, right? Because I think that private capital is seeking yield. It's interested, but what it needs is almost the go ahead. And that go ahead, that incentive can only come from their own governments in terms of guarantees, in terms of the sort of enhancements, and in terms of the signaling effect that comes from looking at partners like the AFC, like other kind of developing country entities that know the market, that that may be willing to take a risk on a particular sponsor that maybe might not seem like an obvious choice. So in summary, I think it's about creating the incentives and providing the guarantees that can incentivize their own local capital to follow.
Great, thank you, Rita. Samantha, please. Sorry, you're muted again.
You would think after months of Zoom calls, I would have worked this out. So my apologies. So I think two things, building and echoing what Michael said. I think this expansion of the country compact idea potentially has a lot of legs, but also tasking then countries actually looking at what their bilateral DFIs and what their donor agencies are doing really to kind of gear up behind those. And secondly, I would task, just as they did with tasking multilaterals to look at balance sheet optimization, I would task them to look at this local currency financing issue.
Very good, thank you. So Nancy, last word on this question, but more generally, the entire session, I'll leave it to you.
Well, just given my previous jobs, I love the opportunity to task the G20. So I would task them in three areas. First of all, in assessing the overall capital adequacy of the private finance arms of the multilaterals. I think almost certainly there is not enough capital in those institutions in the post-COVID era to increase the scale of their operations to the size needed. But I would, number two, and closely related, ask them to consider not just putting more capital in the current model, but putting capital into something that helps adapt the current model to do all of these difficult things that we've been talking about, which means managing more risk, but also moving into low-income market and early stage finance. So this is a time really where the model has to be adjusted. It's not just a question of more capital in the current model. And then the last thing I would task them with is thinking about concessional finance and blended finance in this context. Is there enough concessional finance in mobilizing private capital? I would say no. As I mentioned, it was only about a collective $1 billion in 2018 across the DFIs. But if more concessional finance is to be allocated, it needs to be allocated carefully for the maximum mobilization of private finance per dollar committed by the DFIs. So I think there have to be very, I would still go with targets, aggressive targets with respect to mobilization and with respect to where the blended finance transactions are. Low income countries and also neglected sectors like health, education, and agriculture. Thanks.
Great, thank you, Nancy. So thank you to all of our panelists, our wider group of commentators. Really an excellent session, so much to digest, and fortunately the session will be available to watch later. Just a reminder that this is day 2 of a 4-day conference on financing in low-income countries. You can go to our website at cgdev.org to see the details for Wednesday and Thursday of the conference. And would encourage you to tune in. So with that, thank you again for the session, and look forward to seeing you again sometime soon.